So, are you a high net worth individual looking to scale your real estate portfolio and investing, but you don't want to do all the active work? You don't want to manage the tenants, you want to invest passively. And if so, what should you look for when you're investing with an operator? And that's exactly what we're going to do in this video. I'm going to guide you through the process of evaluating syndication deals and operators as well, with some real life examples, including one of our recent deals that we did with Overlook Apartments. So let's do this. Hey, my name is Michael Blank, and I help people become financially free through real estate. So the problem really is that you're evaluating, you want to get into alternative investments. And in order to do that, you have to align yourself with an operator in that asset class. So it could be, in our case, multifamily or self-storage or mobile home parks. There's a variety of operators out there. The question is, what should you look for? Which kind of operator should you invest with? And this can be kind of overwhelming, but it doesn't have to be, actually. While it's a little bit more than picking a stock in the stock market, though a lot of people just either throw a dart in a dartboard or they trust their financial advisor to take care of them, like I did. And then it turns out it doesn't really matter if your stocks goes up or down. They still get paid whatever fee they're getting paid on. And it does not really put you in control of your financial future. And what I love about alternative investments is you can get a lot closer to the asset class that you want to invest in this case, real estate. Maybe you've invested in some real estate before, you have some rentals, or maybe you flipped a couple houses and you're like, my gosh, how do I, number one, scale this? And number two, how do I make it more passively because you're a high income earner? And so the solution to this is finding the right partner, the right operator in the multifamily or whatever asset class you're getting into. And there's really four things to look for. One is the track record of the partnership. And I'm talking about the partners as well. How many deals have these partners done together? Because what happens a lot of times is each deal has a different set of partners. It's the first deal they've done together. Well, there's really no track record as a partnership. So how long have the partners really been doing deals? Have they been through maybe a couple market cycles? Have they asked questions around their collective track record together? Number two is, to what degree do they communicate with you and the investor base, right? How transparent are they with you about their underwriting or about their deals? So look for how they communicate, and what you're looking for is really a high level of communication, monthly communication, webinars, newsletters. Ask that operator, what kind of communication can you expect? Number three is obviously, in addition to quality deals, but you're really looking for conservative underwriting. And we're going to talk about that in a second as you actually evaluate deals and what that really means. But I see so many different operators put out fantastic, marketing materials about the great return that they're going to get. But you look at the underwriting and they're being overly aggressive. I mean, the truth is, I can make my spreadsheet say anything I want. That doesn't make it actually a low risk investment. So look for a conservative underwriting and ask some questions around that. We'll get into that in just a minute as well. And the fourth thing for me is very important, especially getting into a new asset class, is to what level will they go to educate you? Right? Are they going to show you how to invest in this asset class? Are they going to guide you through it? Are they putting out blog articles, YouTube, social media, maybe even whatever courses? To what degree are they willing to educate you about that? And for me, the biggest thing is a variety of details I'm going to go through right now about how to invest in this thing. But I think the theme for me that stands out for me is a book called Who, Not How by Dan Sullivan. He's one of the most famous business coaches of all time, up there with Tony Robbins. Who, Not How. And really, in this particular thing, it's really the partner you pick. Because if you pick the right partner, that takes care of the other hows we're going to talk about here in a second, such as the right market, the right deal in the right market, the right underwriting, right? All the hows are going to be taken care of by the right who. So focus your time on picking the right who. Now, having said that, you should at least know the what of investing so that you can pick the right operator and pick the right who. So the first thing is focus on the right metrics. There's a few metrics to focus on. One is the internal rate of return. And this is a metric used to estimate the average annual return an investor can expect from a property over a specific period, but it takes into account both the cash flows generated property, the appreciation over time, and also the passage of time. And the IRR is really the thing to use to compare one investment with another. So there's investments that are very cash flow heavy, some that are just appreciation heavy, sometimes they're mixed, sometimes they're shorter, sometimes they're longer. And the IRR takes into account all these things. So it is the great way to compare one asset class or one investment to another. So look for the internal rate of return. In our world, a good acceptable rate of return is 13 to 15%, and it's very similar to the average annual return, for example, which is simpler to think, oh, I'm getting a 10 or 15% average annual return. But for example, if you do a refinance with a multifamily, it does not. The average annual return breaks because now there's some capital coming back 2-3 years later, and the IRR takes that into consideration. So look at the IRR as you evaluate different investments. The second one is cash-on-cash return. This is the metric that calculates the cash income earned on the cash invested in a property over time. And this is a great way, especially if you're trying to exit something or build passive income, you will look at the cash-on-cash return. Then there's the equity multiple. Equity multiple is used to determine the potential return on commercial investment. It's the return on your equity. So it's calculated by dividing the total cash distributions received from investment by the total equity invested. So for example, we always talk about equity return. For example, how quickly can I double my return, right? If we have 2x in 5 years, that means we can double the investor's return over the 5-year hold. The cap rate is important only because it affects price. But again, it doesn't really matter per se what the cap rate is going in as long as it's market rate, but it's really used to calculate the value of the property. So it's really the ratio of the property's net operating income, okay, to its purchase price. It's that ratio. It's how you value basically a cash flowing business. It's a ratio of the income generated. So it's really something to look at as a buy, but it's not nearly as important as some of the other metrics I'm talking about here. And the last one I want to highlight is the debt coverage ratio, DCR. It's what lenders look for. It's a measurement of a property's ability to generate enough income to cover its debt obligations. So it's important because the banks are looking for a ratio of 1.25. They want to make sure that the NOI, the net operating income, covers the debt service by at least a factor of 1.25. There's enough cash to pay the mortgage, basically. Now, those are some of the important metrics, but like I said earlier, focus also on the assumptions behind the metrics. Because again, I can make my spreadsheet say anything I want, and I can make up average annual returns and IRRs all day long. Okay, that doesn't actually make them real. So look for things like rent growth assumptions. If the rents are going up by more than 3%, ask why. Why are there market reports that substantiate rents going up by that? Historically, they've gone up 2-3% a year. And if they're going up in the projections more than that, you want to ask why. Maybe there's a good reason. For example, in 2022, the rents went up by 25%. Maybe there's something going on in the market. Ask the question. What about vacancy, right? Vacancy rates, sometimes you'll see vacancy of 5% or 10%, but it's a heavy value add deal. So what happens when you're turning over the units? You're going to have a higher vacancy rate because you're essentially, you're not renewing rents, you're doing renovations, and so it's going to be vacant longer. So the vacancy rate might have to be substantially higher than 10%. If it's showing 5% in year one, then they're doing heavy value add. Is that realistic? What about the exit cap? We talked about the cap rate going in. It's this multiplier, and it's got this inverse relationship to prices, right? So if the cap rate is going down, that means that prices are going up. Likewise, if the cap rate is going up, then the prices are going down. It's got that inverse relationship. So what is the exit cap rate, Mr. Operator, Mrs. Operator? Show me, what is the exit cap rate going now? What is that market rate? And then explain to me why you think the exit cap is going lower, for example, or staying the same, or going higher. Explain to me a reasoning behind that. And then reserves. What kind of reserves are you putting into the underwriting, right? Because if I put no reserves in the underwriting, well, shoot, my numbers are going to be much higher than an operator who actually puts in reserves at closing and withholds cash reserves out of cash flow. All these things add layers of a margin for error to that. So you have to ask questions as a passive investor. I see so many investors simply not asking questions, and a lot of it, you have to check and see if the answer to those questions makes sense to you. Other questions to ask is, what about the market? What do you know about the market? Is it a growing market? Why do you think it's a growing market? What data are you looking at, right? Number two, about the business plan. What's the plan to increase rents? What are you going to do to renovate? There's a construction budget. What are you going to do? What's the budget? Is there a reserve to handle unforeseens? No reserve? That's bad. That's not conservative at all. Do the answers make sense? Are they achievable, right? So it doesn't, don't have to be a huge expert necessarily in multifamily. You know just enough, but ask questions. Ask common sense questions. And I just told you some of the questions to ask the operator. To what degree are they addressing them? Are they evading you? Do they make sense? And so these are some of the questions to ask. And so what we do, and when we have a deal, is we actually do a webinar and we go through and try to best of our ability answer all these questions proactively. Then we do a live Q&A. We have the replay that goes out. Once the deal closes, for the next 90 days, we have monthly webinars about how it's going, just to keep you in a loop on what's going on and make you feel good about investing with Nighthawk. And so, so these are some of the things to look for, and it is a really good time right now to get started investing. We have very strong fundamentals. There's strong demand for affordable housing, and you can't build any more affordable housing, so that means that rents are going to continue to rise, and therefore prices are rising as well. And so prices are down from March of 22 at the high point due to the interest rate hikes and market uncertainty, and they are now stabilizing, and the interest rates are projected to stay equal to or most likely go down. That's going to result in an increase of prices as well. In fact, if you look at the price projections or the cap rates, you already see them. The projections are that they're headed back kind of where they were before. So it feels to me like we are towards the bottom of the market. Therefore, it is a good time to start educating yourself about this and to start talking to operators. And we would love to be your trusted operator in a multifamily space. Over the last 7 years, we bought and sold 2,800 units valued at $550 million. We've had a number of exits. We've achieved consistent cash flow. We've dealt with some difficult situations, and we've been able to navigate that successfully. So we'd like to take our collective experience to you. The way to do that is just to check us out at nighthawkequity.com. There's a way to join our investor club. If you do that, you get early access to some of the best deals before other people see them. So just check it out. Go to nighthawkequity.com and click the join the button. Have a call with us, and we'd love to get to know you better and share some upcoming opportunities with you.